All right, it looks like the attendee numbers have slowed down, so we will start today's webinar. We've got a fantastic one ahead of us, the Great Supply Chain Disruption, Implications for Australian Business Leaders, and I will be joined today by the man of the hour, Sam McPherson, who is Head of Treasury at Early Trade, and he will be discussing their quarterly Australian supply chain scorecard and outlook. I'm not going to take away his job of introducing himself and his presentation. But Sam, thanks for joining us today. Great to have you along.
Thanks, Pat. Great to be here. Thanks everyone for joining.
Yes, of course. Thanks everyone for joining. Almost the end of the year. I know that we've put on plenty of webinars and there's been plenty of Zooms and Teams and whatnot. So I appreciate you taking the time today and joining us once again for a Creditor Watch webinar looking at supply chain disruption. Really just quickly a little bit about Creditor Watch, as all of you should already know. We are a credit reporting agency, an end-to-end credit management platform, giving you the ability to do a wide variety of things, access various products and features, including the ability to onboard your clients with an online credit application, run credit checks, credit ratings, payment ratings on your customers or suppliers, monitor those entities for changes ongoing. So it's great to do that check up front, but what happens if they go into administration next week, have a court action next month, that sort of thing. So there's going to be plenty of changes ahead as we navigate our way out of COVID, and hopefully that new variant stays quiet and doesn't disrupt too much of everyone's plans. I know I've got some plans to try to get away, and we've got people flying in from overseas who are certainly watching the updates. So I'm not going to talk about the products anymore. You can jump on the website and have a look. That's not why we're here. Key highlights that I do like to touch on: Creditor Watch has a huge amount of data that we're pulling into our bureau from various sources, public, private, and government and otherwise. Gives you the ability to access information on any company, business, sole trader, trust, partnership in Australia to assess their risk and what risk they pose to your business, whether they are a key supplier or a debtor that owes you money. So please have a quick look at that. We will send the slides around, of course, after this presentation. But I think, you know, what we're all here today to hear from and to understand. Over to you, Sam. Take it away. Sorry, I should add, please, if anyone has questions, do ask questions. There'll be time at the end, but I'll keep track of those as we go through the presentation, as Sam goes through his presentation. And if I find anything that's really timely, Sam has kindly agreed to not take offense if I interrupt him mid presentation or midstream and answer the questions. But I also promise not to throw him under the bus with any tough ones either. So if anyone does have any tough ones, you can ask them rather than me asking them. So Sam, without any further ado, over to you, mate. Thank you for joining us again.
Awesome. Thanks, Pat. And thanks again, everyone, for joining today's webinar. As Pat said, I'm Sam McPherson. I'm the Head of Treasury here at Early Trade. Prior to joining the company, I did spend just over 6 years over at Qantas in their Treasury team on the risk management side of the business. Again, to reiterate what Pat has said, you know, we're going to look at the great supply chain disruption as we've kind of coined it, but also then look at the flow-on effects for the Aussie economy and some of the key risks that, you know, certainly the conversations we're having with business leaders, what are the key risks that they're looking for? I think particularly relevant at the moment, as you said, Pat, you know, the Omicron, and I think there's going to be more variants, unfortunately. And what does that mean, you know, from a business continuity perspective going forward? As you said, you know, pop your questions in. Hopefully not too hairy, but fire away, and we'll knock them over as we go, perhaps. To quickly cover off who Early Trade are, you know, I know some viewers may not have a feel for who we are as a company. We actually think, you know, from our perspective, we're very well positioned to comment on this sort of supply chain disruption because we own and operate Australia's largest early payment marketplace. And that's become a very key network for liquidity in the supply chains of Australian companies. As you can see, we work with a number of large customers there on the left. There's a few of them. In FY21, to give you a feel, we made over $5 billion of liquidity available to just over 70,000 suppliers, as you can see in the middle there. In the next year, that will surpass 100,000, and we're anticipating the dollars will actually double as well. Final point I'll make on the right there, looking at the actual businesses that use the platform, it's a very good sort of cross section of small, medium, and large suppliers within Australia and New Zealand. And with that, the data that we see, which we'll take you through a little bit of as well, it acts as a very good barometer for the health of these supply chains and then, the health of the broader economy. So as we all sort of know, global supply chains are close to breaking point. Whether it's the timber shortage globally, the fuel and energy shortage over in the UK and China, major issues in semiconductor supplies, or I guess here in Australia, the run on toilet paper we even had last year. But if we step back and look at all of these sort of issues, they're largely being driven by three key reasons. The first one, kind of obvious, the global lockdowns that have permeated through society, they've obviously had knock-on effects from a production perspective. Whether it's factories shutting down or significantly reducing their outputs, it's meant that obviously the amount of supply or the amount of produce that's available has fallen significantly. Secondly, consumption patterns have shifted seismically. We've gone from sort of a service-based economy in the developed world to goods. Everyone's moving their consumption away from obviously services which couldn't occur because we were locked down, and more into the goods section. And that's had huge ramifications from a shipping perspective. So we've had firstly a shortage of actual shipping containers, but also this mislocation of shipping containers as well, whereby containers are essentially in the wrong place. They're not in the places where they need to be to meet the demand that's actually flown through. As Pat mentioned, we produce a quarterly scorecard. And what this takes into account is some of those external sort of metrics, so those shipping costs, but also then we look at some of the data out of the early trade platform as well. And as I mentioned, we see that as a very good sort of barometer or gauge for the supply chain pressure that's being felt. Now, as you can see on the screen, unfortunately, that's flashing very red. To us, that's indicating a very high risk within the corporate supply chains. As I said, the first piece that we look at is those external factors. So shipping costs, they've gone up more than 2.5 times over the past year. And that's also had flow-on effects for delivery times, for backlogs. I'm sure we've all experienced it, both ourselves, but in our own businesses as well. Whether it's Australia Post struggling to get our mail through fast enough, or whatever it might be from a supply perspective, it's taking much longer for those goods to actually arrive on shore. If we flow through, and we'll take you through a bit more of this in detail as well, but we've actually seen huge uptick in usage of the platform, essentially from companies, particularly small and medium-sized businesses, looking to shore up their cash flows, looking to get a lot more certainty into their business by bringing forward some of their invoice payments that are due, in 30, 45, or 60 days, perhaps.
And Sam, just on that, sorry to interrupt so early on, would you say that small businesses are impacted more than a large business would be, or it's fairly standard and dependent on the industry that they're in?
Yeah, I think probably twofold answer. Yes, it's obviously very industry dependent, and I think I do actually have a little bit of that here in terms of where that disruption's been largely felt, and that wasn't even a planted question. That this is genuinely what's being experienced. But yeah, the reality of it is there was an ABS study done sort of a couple of months ago, and 40% of Australian businesses said that they were experiencing supply chain distress ultimately, and it was impacting their business to a great extent. As we can see, there's certain sectors where that's being felt more than others. Transport services, wholesale trade, anything that's essentially sort of import-export business, kind of intuitively. But the worst, I think the hardest part about it, certainly from our perspective, is the brunt of that is actually being felt by SMEs. So those small and medium-sized businesses are actually really struggling here. As this chart on the left, essentially they're 50% more likely to be feeling the pain at this point in time from those supply chain pressures. When I kind of look at why that is, I think there's three key considerations here. So one, if you look at the nature of these businesses, generally they're not able to pass through cost increases quickly to their customers. It's obviously a competitive environment. Your big sort of oligopolies, monopolies, they've got obviously, a number of suppliers they can generally choose from. So in this competitive position where they can't naturally pass through that price increase, so they either take a hit to their profit margin or they don't supply. Secondly, a lot of them, I guess, in the big end of town, we've seen this shift into the digital or online sort of channels. For these smaller businesses, a lot of them don't have the capability or the resource to do that, so they're unable to actually make that pivot over the last year or so. And then the third one, which is where we as early trade, from a working capital management perspective, become most interested, is if we look at those larger corporates. There's been a lot of reports, particularly in the retail sector, where essentially they're able to increase their order book, bring more inventory in, store it in a warehouse, all those sorts of things to shore up or guarantee supply. Unfortunately, small businesses don't have that luxury. They're generally working capital constrained. They generally don't have a warehouse necessarily to just store additional product in. They operate on a just-in-time sort of delivery model. So this chart on the right is very interesting, particularly for me, from a treasury and finance perspective. What it does is it actually draws out the difference or compares borrowing costs for large corporates, and that's highlighted by essentially, the cash rate or the
and they can tap public markets, right? Whereas
exactly.
A small business is what, got 10 weeks of savings generally at best.
Exactly right. It's savings, it's overdraft facilities, it's remortgaging. Unfortunately for some of them, obviously they've got their own collateral that they're putting down to keep running their business ultimately, and that's why Early Trade as a business was founded. We're trying to provide additional kind of non-traditional financing methods that gives them a lot more flexibility. They're not locked in, and as you can see, we're kind of finding a place here in the middle where they can actually access much more affordable capital. I think the unfortunate part of this is that even though there's obviously been a whole lot of stimulus thrown at the economy, that things like the term funds facility and other obviously stimulus measures that were intended particularly for small businesses, they probably haven't flown through to the accounts that they were necessarily hoping, for a variety of different reasons. But yeah, that's ultimately what we're dealing with, this disparity in where capital can be accessed by business sizes. And I guess to give you a feel, we said we'd talk about some of the data that we've seen out of the Early Trade platform, and that's exactly what we've seen. So over the last year, we've had about almost a fourfold increase in early payment demand from SMEs. These businesses, they're trying to bring in enough capital to, well, I guess firstly stay afloat over the last year, but also take measures where they can to actually, reduce the risk in their own supply chain. So I think to me, this is a very good indicator of the cash flow pressures that these businesses face, struggling with this combination of all of these supply chain issues, but also then looking at the demand side as well, which is obviously particularly uncertain. Some of the anecdotal feedback we get, we've got a whole cross-section, as we said, of suppliers that use the platform. You can see on the screen here, I think this nicely encapsulates the kind of issue they've got. All of their costs are up, but this particular supplier is saying, I'm unable to raise prices at the moment to my customers. So they're essentially trading on zero margin, or even at a loss in some circumstances.
And we've seen, through our numbers that, particularly for small businesses, revenue on average, I think we're down sort of 37% year on year if you compared October 21 to October 20, and then 20 was down itself, almost 20% as well. So the revenue has just disappeared.
Yeah, I think it's a really interesting point. We obviously operate on the supply side of the economy, but it's very interesting looking at, and we'll do a bit more on it, but looking at how those supply chain pressures and those supply chain issues start to impact the demand story as well. Again, particularly compounded by obviously the longer these lockdowns go on, I guess the more or the greater the risk of snap lockdowns as well with new variants. I think that's what we're kind of seeing. These supply chain pressures are going to resonate for a while longer yet. the unknown for me in particular is what happens on the demand side. So obviously it's TBC. But as you can see on the screen, the risk in my mind of all these supply chain pressures that we've got at the moment is they're going to emanate for a while. They're going to be here for the foreseeable future in terms of what we've seen. Now, the risk there, I guess, is you get this upside pressure, obviously, on inflation. It's obviously been the trend talking point of the last 2 or 3 months, let's say, globally. But I think what we're finding now is, there is a real risk that it's not just transitory, and you've got these shorter term or medium term, perhaps, supply chain pressures. They're actually starting to compound some sort of more secular shifts within global supply chains, moving to a digitized sort of supply chain. If you kind of step back and look at something like Brexit, complete lack of foreplanning there obviously led to a lack of truck drivers. So things like this are actually being compounded. And then you add on US-China sort of trade relations as well. Like it's a very murky outlook from a supply perspective, and we're getting a double whammy now with all the pressures that are being seen as well. So I think you've got this position where there is probably topside risk to that inflation story, certainly compared to what the RBA are forecasting, which is what we've got on the screen here.
So I don't know if you make a prediction, but and if you're going to do that on the next slide, just tell me. But do you have a date for the next cash rate increase?
Very good question. Obviously, very pertinent at the moment. Listen, I don't think it's on the radar in the next 6 months, put it that way. But I also don't think it's as late as 2024. Particularly here in Australia, like we just need to look overseas, right? Look at some of the data prints over in the US. Obviously, the economy is pumping along quite nicely. A lot of sort of over delivery from a data perspective, or beating expectations. So I think, the Fed is probably going to have its hand forced to move down that QE, tightening the QE sort of belt maybe a little bit faster. And I think, we'll naturally follow probably 6 months after, perhaps. So maybe middle to back end of next year, I think, is realistically where it comes in, which is probably maybe even still a little bit ahead of where the market's pricing right now. So I did say we talk about the reopening as well, because I do think it's very interesting to look at that, the interplay between the supply story and the demand side of the economy as well. And I think especially at the moment, it's a very pivotal time. Obviously, everything reopening, touch wood, that continues. But we do have obviously a few uncertainties on the horizon, let's say. I think it's important to look at, if we look last year, what happened when that initial lockdown sort of eased. There obviously was, that big jump in GDP as we all got out there and started spending ultimately the cash that we'd been saving. Now, if we look here on the right-hand side, that savings ratios, as we've seen, it's jumped to near 20% at the height of those lockdowns. And that obviously went hand in hand. As things opened back up, we got back out there and we bought large goods. We bought furniture, we bought office equipment, we bought new cars if we could get our hands on them, all those sorts of things that we'd been waiting to buy. Now this time around, there's very much an expectation that, okay, everything, the economy opens back up, restaurants, cafes, bars, shops open back up, and we get out there and spend to the same extent. I think when we look at this, it's important to look at, what's different perhaps this time around. And I think there's a couple of key things. Firstly, we're now in this environment where we're living with COVID, right? We're dealing with, how do we go about trying to do normal things, if you will, but also still having, a fair bit of obviously the virus flowing through. So I think you got to look at what happens to, a business when a large portion of their workforce is stood down or has to isolate for a period of time. That's going to impact output. What happens when you have large restaurants where there's outbreaks and those sort of things, and a lot of those customers are then put back into isolation? I think it's going to have ramifications for the propensity of people to get out there and start doing all of the things that we all want to be doing. Secondly, as I said last time, we saw a lot of spending on big household items. Now, this time around, despite what my wife tells me, we don't need to go and buy all of these again. we don't need to buy new TVs, new sofas. Like we've done that once a year ago. Now it's probably another few years away before hopefully we need to go and do that again. So I think again, it's really saying this spending needs to shift very quickly back into the service side of the economy. And again, depending on how keen people are to get back out and be doing all those normal things, that could obviously have huge impacts as well. So the
Sam,
ultimate message there.
If I may, sorry, just to cut you off, a question that's sort of come in as well is, how important, or is there a big difference between business investment and household spending here? Obviously we saw with businesses, everyone tightened their belt, stopped spending, particularly when everything was shut and everyone was looking for a bit of certainty as to when the borders and lockdowns would come to an end, and then we saw this sort of uptick in business investment. Do they play the same role? Is one more important than the other?
I don't know if one is more important than the other. I mean, from a dollar perspective, obviously they're both fairly significant.
Worth the same. Yeah.
But I think the reality of it is, it's just that uncertainty that permeates throughout the economy. So whether it's directly on the consumer or it's directly on those large corporates, those decisions to make longer term business investments, they are impacting. You see obviously in these times of heightened uncertainty, businesses stepping back, focus on the BAU, shore up the balance sheet, hold additional liquidity until such time you do get that a better line of sight into the future as to what that investment channel is going to look like. So yeah, no doubt that will start to come back through. I think what we're saying here from a consumer perspective is the risk in our minds is really you end up with a slightly more elevated savings ratio. Yes, there's naturally going to be an increase in spending as things open back up, but does that last for 1 month, 2 months, 6 months? I think that's really going to have an impact on the growth trajectory as well for Australia. And that's what we got here. So we've seen, consumer confidence, when we compare that to the red trend line here, it's still pretty low. And with that, a large portion of that is being driven by buying intentions. So people's buying intentions, the longer lockdowns have gone on, I guess the more risk averse people have kind of become, and essentially looking after their own personal balance sheets. They're saying, maybe I'm not going to go out there and spend all the cash that I've saved up over the last year, because I want to keep a bit of powder dry in case the worst happens in the next 6 months and we've got another lockdown or whatever might flow through there.
And we usually see a bit of a slowdown as well coming into a federal election, right? Particularly, even basic government spending, they shut up shop, and larger businesses as well also keep an eye on. And I think it's probably close to a 50-50 call as to who's going to get in, which also probably slows down spending quite a bit as well from a business perspective, because businesses feel there's a big difference between a Liberal government and a Labor government. We won't get into the politics of that, but do you see that potentially having a bit of an impact on spending?
Yeah, absolutely. As you said, naturally from both the consumer and business side, you do naturally see this pullback, which I think is unfortunately a double or triple whammy when you do have, as we said, these supply chain issues that are ongoing. You've also got this sort of let's say volatility in business uncertainty as well, or business confidence, I should say. And then that's I think in the early stage of next year, obviously depending on when they end up calling that election. I think it's going to have a compounding effect, unfortunately. And all of it, what we've got on screen, this is all unfortunately coming at a time where obviously that stimulus has been rolled off significantly as well. So last year, I think it was averaging close to $30 billion a month of stimulus flowing through the economy. This time around, obviously, it's pretty much flattened off to near zero. So ultimately, again, it's putting the onus back on, from a household perspective, that savings ratio or that savings buffer to actually support the spending story. So again, if we don't see that rebound, there is a significant risk that we're not going to see that sort of growth trajectory that we're kind of hoping for as well. And that's, again, to touch on some of the platform from the early trade, from the data from the early trade platform, that's what we're seeing as well. This increased uncertainty, particularly for small businesses, we've actually seen that flow, 3 sort of examples over the last year. as those stimulus packages have rolled off or certainly been reduced, we've seen big upticks in usage of the platform as well. So you can see this chart on the left here shows registrations of small businesses. So these are new businesses coming onto the platform for the first time, essentially trying to get better visibility of their cash flows, but also then giving them another liquidity option. So, as and when they need to bring that cash into their business, they've got it on demand ultimately. So what this is these businesses trying to, again, get as much certainty as they can. And I guess that's the insight here is, that uncertainty for small businesses is at an all-time high. They're looking to, reduce that uncertainty wherever they can. If that's through the Early Trade platform, then fantastic. It means that they can access cash that's owed to them, as and when they need it. I think that's really important, again, from that demand perspective, because, for small businesses make up, there's about almost 2.5 million small businesses in Australia, right? So from a work perspective, from an employment perspective, they make up about 40% of the workforce. So if we flow through that uncertainty story, huge ramifications for the owners, but also the employees of these businesses, which then means from their perspective, what happens to the demand side? Like, are these businesses going out and investing their own cash? Are their employees, nest egging a bit more for a rainy day in the future? I think that's what we're seeing. This level of uncertainty flows through, and we actually end up with an elevated savings ratio, which obviously means underwhelming consumption. So in the scenario where you've got, inflation pushing higher, GDP or economic growth kind of disappointing, let's say, particularly when we look at the RBA's forecast over the next sort of 2 years, which obviously doesn't create sort of a great or the most rosy outlook, let's say. I think the most interesting thing that we see from a data perspective is actually the correlation between supplier registrations or business registrations, regardless of business size. So this is small, medium, large companies registering to use the platform and access their invoices early. And that correlation with business confidence. So we've got the NAB Business Confidence Index over time. That's shown by the darker blue line here. And you can see that the number of registrations or the registration activity of businesses is actually a very good leading indicator for that business confidence story. So if we look at a couple of examples, last March, when obviously the COVID sort of pandemic began, we saw a huge uptick in business registrations on the platform. Subsequently in April, we obviously saw, as you can see, that huge dip in business confidence. Again, roll forward to this sort of year as well. So July this year, when the sort of New South Wales lockdown began, I think that was back end of June or early July. Again, we saw big uptick in platform usage, and in the dark blue line, we saw the spike in or the big reduction in business confidence as well. Interestingly, we've seen in the last few months, we've seen a spike in registrations as well. And to me, that just says over this December quarter, there is the chance that business confidence again falls, which unfortunately I think Omicron may have a compounding effect on as well. So that's what we're seeing from a data perspective. Much more caution from businesses from a spending perspective, which from an employment perspective, obviously we've all seen what's been going on there. I'm not going to harp on here too much, but I think the reality is, when you've got business confidence jumping around a fair bit, you've got obviously tight labor markets in certain sectors, but what we're now seeing is ultimately the people that are coming back to the workforce and taking that participation rate higher, they're not necessarily the people that want to go and work in the industries where those employees are actually needed. So you kind of got this dichotomy of, a need over here, but supply over here, which is actually creating quite a messy story, I think, over the next probably 6 months. And
it's very mismatched, isn't it?
Yeah, it's mismatched, and I think I think there was a headline this morning that the federal government are going to delay the migrant worker at least for another 2 weeks as well, and that all just builds that same story as well. So I think the key risk here is that business uncertainty permeates over the next few months. And the businesses that have kind of stepped back from hiring, they're kind of saying, no, actually, I want to shore up, my own internal, like my business as usual. I want to get that better visibility over the next few months about what my actual business operations look like before I start hiring again. Whereas those that do want to hire and are in a position to hire actually can't get the workers that they need. So a bit of a huge mismatch from that perspective. I think ultimately that's what we're kind of saying. The key risk here is that you end up with, the stimulus obviously coming off at the same point in time where business uncertainty or business confidence is jumping around a lot, which then add on that story of the potential story for the savings ratio to remain elevated, and you actually end up in this unfortunate position where stagflation does become probably relevant. Demand or economic growth sort of plateauing or potentially falling off into the start or middle of next year, but inflation remaining constant. I think that's a given, is that the inflation story is going to remain constant. The big unknown is what happens on that demand side of the economy, I think. So I think from our perspective, what we've kind of run through there, what we've seen through the supply side data, it's having obviously those inflationary pressures. There's a real risk there that it's not just going to be a transitory story, because you've got all of these supply chain issues that are coming at a time where now we've got obviously shortages in the labor market as well, which will add to that inflationary story too. Unknown, I think, is what really happens in this post-lockdown period. I think the reality is there's going to be a sort of limbo period or a transitionary stage where we do start to get back to spending. Do we reach the same sort of levels over a 3 or 6 month period that we were sort of pre-lockdowns, pre-COVID, all those sorts of things, or are we more risk averse as a society, meaning that you don't actually get that huge or sustained uptick in spending over time, which, as we said, leads to that sluggish sort of GDP outlook as well. Adding on that final piece, stimulus rolling off at that same point in time, there's a real risk, I think, that you get upside move in unemployment, again pushing that agenda perhaps for those stagflationary pressures to start to build. The longer the inflation story plays out, I think that's the reality, and stagflation becomes more and more of a potential. I think if we step back and look at, certainly for those of you on the call, as business leaders, like what are we really saying here? Like, what do you need to be looking out for, within your own businesses? I think there's a few things. The first thing I'll say is be alert but not alarmed. It's getting a good run in the media at the moment, but I think that is really where we're at. The first thing to call out is I think there's going to be a lot of unpredictability. So from a cash flow perspective, the normal sort of trends or seasonality that you'd see perhaps in the run up to Christmas, I think that's already being impacted. So, that expectation that you have, maybe start to look in a bit more detail and say, well, are we following the same sort of cyclicality that we've seen in the past? Or is it a lot more unpredictable, and what do I need to do from that perspective? That's going to flow through, again, volatility in markets. So we've already seen, over the last couple of trading days, how the heightened level of anxiety within financial markets has flown through. Obviously, Omicron's sort of resonating, and we've seen big sell-offs and then sort of whipsaw action back in the other direction. So that volatility is going to hang around for a while. And I think it's going to permeate through to the macro sort of data points as well. Interesting one here, a lot of the business leaders that we talk to, they're running their business, with some assumed correlations in mind. So again, that can be financial market related, but it can also be behavioral as well. So do you run your business based on certain assumptions? If so, it might be worth pressure testing what they look like at this point in time as well. And then I think, certainly relevant for us, but from a supply chain perspective, it's kind of twofold. One, this increased focus on supply chain risk. It's certainly, read any of the obviously sort of mainstream media publications, certainly big sort of C-suite focus on these issues. And I think what we're finding is, a lot of companies are now rolling supply chain into their risk management policies as well. So start to look out for that. Ultimately, look at, step back and look at what technology is available to you as well, to actually help you. Because one of the, obviously the avenue for us from an early payment perspective, we talk to a lot of companies who say, yeah, we get a lot of manual requests from our suppliers or businesses that we work with to pay early. Becomes a bit of a nightmare from a process perspective. So obviously for us, that highlights where the technology need is, but also looking, I guess, Pat, from your perspective, getting better visibility as to who your suppliers are. What sort of level of understanding do you have about them from a financial perspective? Are they a heightened risk of going into default during this period? How can you perhaps better collaborate with them in a way that's sort of seamless and obviously streamlined? Because ultimately, to me, it's all about managing the risk to your end user or end consumer. You don't want to be in a position where these supply chain pressures resonate for a while longer, meaning that you can't deliver either the good or even the service that you're trying to deliver to your customers. Because obviously that's kind of the worst case scenario for a business, I think.
And we've had a question specifically come in on that. And it's what mechanisms would you suggest SMEs could take to minimize supply disruption or supply cost increases?
Yeah, very, very good question. I think very relevant. The final bit is very interesting. And, if we start again at the big end of town, a lot of those conversations, it's really becoming a decision point to say, well, given the uptick in input costs, there's a couple of ways you can manage this. Firstly, the big business can absorb those increased costs themselves and take that hit to their profit margin, or they can pass it through to the end consumer. Or the final one, unfortunately, is they can push that onto their own suppliers as well. So I think the first point is be collaborative with those big customers that you've got. Work with them to say, well, you don't want, you want to mitigate that risk of impacting your end product as well. I want to obviously shore up my business as sort of the conduit between that input and the end user. So there's a position where it works for both sides, and it could be increasing purchase volumes, and agreeing those on an ad hoc basis. It could be more about looking at, what sort of cash flow options do you have, and obviously I could spruik early trade here for a long time, but that's ultimately what we're trying to solve, is to be able to give those liquidity options as and when they're needed, to allow suppliers, whether they're small or medium sized, to come into the platform, get the cash flows that they need, and ultimately shore up that supply chain story for themselves as well. So I think my advice there would be collaborate with your customers. Like, now is the time to be doing that.
Yes, I think that's a really important point, is don't wait for it. I mean, a lot of businesses obviously will be, unfortunately, having that issue at the moment around rising costs. But if you're not, don't bury your head in the sand and expect it not to happen, or think, oh, I'll deal with it down the track when it happens. Get something set in place with your customers and your suppliers, right? It's about the supply chain. So we've usually always got suppliers and customers. So set the expectations around those price rises. So if they are coming, there's a way that you're able to mitigate it at both ends of the supply chain with your customers, to be upfront, so it's not a surprise for them to all of a sudden get hit with an increase, but also so you're not surprised. There's a mechanism for those increases to come from your suppliers as well.
Yeah, absolutely. I think obviously if you're in a position where you've got an inflation-linked contract, then perhaps not such an issue, and that could be something that going forward you're able to roll into those agreements as well, where obviously you can either share in that inflation sort of uptick, or pass it through to the customer completely. But I think it's just about understanding what your position is at this point in time. Work with those customers, and likewise work with those suppliers, as you said, Pat, and also look at what are your liquidity options. I think a lot of people bury their heads in the sand and say, oh, it's too difficult, my bank won't lend to me, it's too difficult, I need to go to a payday lender and pay through the nose to access capital. That's not the reality. There are other things you can do, and part of that can be let your customer know sometimes, if it is a position that's going to benefit them in particular, If you can get your cash early that guarantees a level of supply, I think most of those customers are pretty open to that at the moment. As I say, from the buyers that we talk to, most of them are now really putting a microscope over the supply chain. Firstly, wanting to understand who those suppliers are that they're working with, and also we haven't even spoken about the ESG side of things as well. But rolling that into the equation, you want to make sure that your suppliers are obviously not only a sustainable or an ongoing business with good cash flows and a robust balance sheet, but also that they're doing the right thing by modern slavery policy, by their emissions. Like, what are they doing from a sustainability perspective? So that's another interesting conversation as well. I think
and probably you could probably do a whole webinar on ESG and the impact that's going to have on business in the future, certainly.
Yeah, absolutely. But yeah, I think certainly those buyer conversations for us are really, companies looking to say, well, what can I do from a technology perspective? I want to collaborate better with those suppliers. And I think particularly, the last week has really highlighted the issue that we're going to have. Like, there's going to be more variance over time, and it seems
we're not out of it. Every time we think we're out of this thing, we get a nice reality check, don't we?
Yeah, exactly. And I think
there's more coming.
For sure. And I think if we've seen the natural policy response has been to buy time. So, shut borders, increase sort of safety measures that are taken, which then just delays that recovery story as well. So that's actually going to compound those supply issues as well. When you've got, again, those factories, being forced to limit capacity or limit outputs, it's actually going to have, unfortunately, inflation. I think the inflationary story is pushed even further by these sorts of things as well. So yeah, I think keep that in mind. Collaborate where you can. Look at what the technology options are that are on the table, and sort of roll them into your existing process if you're able to.
Yeah, I agree. Just conscious of time as well. I know that sort of 45-minute mark is the sort of magic number for most people to stay engaged, and also conscious of their jobs that they've got as well, and lunch and whatnot. Was there anything else that you wanted to touch on, Sam?
No, I think we've covered off a fair bit. I think as I say, the interesting part for me is, like, we've all heard a lot about the supply side or the supply chain issues. There's probably, the extension of that is two things that probably aren't well covered. One is that implication for demand. What's the likely outcome from a demand perspective? I think the reality is that's still quite murky. The longer, as we've said, the longer these lockdowns or maybe a threat of lockdowns continues, the more kind of risk averse both businesses and consumers become, which obviously then has that impact on the demand side. But also, I think, the longer this goes on as well, like, it's going to keep putting the pressure on businesses to look at their supply chains, which can be a very manual process. I think the fortunate thing is that there is a lot of things the technology can do for you as a business. And obviously, if you want to chat to us about how you can do that, I guess, Pat, yourselves or us Early Trade as well.
Yeah, definitely.
Where we are.
Get in contact. There's no harm in at least asking questions and knowing what your options are out there.
Yeah, absolutely.
All right, Sam, I think that's been great. We've answered all of the questions, and I think you've got a couple of keywords here, like unpredictability and uncertainty and whatnot. I think that's certainly going to be the key going forward. But yeah, planning for the future and planning for that is certainly what businesses should be doing, rather than just waiting for it to happen. And I certainly encourage organisations to chat to the team at Early Trade, or to of course chat with Creditor Watch. As always, you should be doing your due diligence on not just your debtors and your customers like we've traditionally provided and pushed, but what does it mean if you were to lose your largest supplier, right? If they were to fall over, arguably would have as big an impact on your business as your largest customer falling over, regardless of whether they owe you money or not. So Sam, a big thank you to you for joining us today. Great presentation, very easy to follow. I'm certainly not an economist or very sort of analytical myself, and I got plenty out of that. So thank you for that.
Awesome. Thanks, Pat. Thanks for having me. And for everyone who tuned in, thanks for taking the time. As I said, we produce sort of that quarterly snapshot of how supply chains are looking. So if you're interested to get that kind of visibility, obviously how that's evolving over time, get in touch. My details are there on the screen, and we'll share this pack around, so you've got obviously the collateral and the contact details as well.
Yep, and we'll have an article up. I think there's already one up. There might be another one sort of summarizing this webinar as well on our blog to get some more information. And I'm very sure that myself and Sam will be on your screens again. I have no issue, doing this on a quarterly basis, because it is certainly really important content people want to know, and it's great to be able to tune in and hear from an expert like yourself, Sam. So thank you again, and I certainly look forward to working with you in the future. And to everyone at home or in the office or wherever you might find yourself, great as always to have you tuning in. Thank you very much for your time. We know it's very valuable, particularly coming into the end of the year. Everyone is absolutely slammed trying to get their work done before we finish up for a well-earned break. So thanks again, everyone. Have a great Christmas if I don't speak to you again on webinars, but keep an eye out for additional ones coming soon. And Sam, as a final thank you very much.
Awesome. Thanks, Pat. Thanks, everyone.